Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
Welcome back to the Sparta Market Outlook Podcast, where we break down the key trends shaping the global energy markets. I'm Rachel Williams, and today I'm joined by Neil and Phil to dive into the latest developments across the natural gas and its impact on the oil commodities, crude and refined products. So hi Phil and hi Neil.
Hello.
Good morning.
Right, we've seen some big moves in the past week. I think we've got TTF gas has climbed towards $60. Crude inventories are building very quickly in the US. We've got physical fuel oil market showing some notable strengths as well. So there's a fascinating dislocation in the fuel oil between the physical and the paper markets that we'll get into in a little bit, along with some geopolitical factors driving market sentiment. So look, let's just jump right in. Phil, Neil, what's happened over the past week?
I can start with what happened last night and got me up this morning adding extra notes onto our little script here.
Yeah.
So obviously there was the talk of Trump and Putin having a call about a potential Ukraine deal, notably leaving out for now Zelensky and the EU. And that was not very supportive for flat price, let's say. I haven't looked at flat price exactly this morning, but last night anyway. So let's leave aside the politics. There's a few scenarios for oil and gas. My read, I suppose, initial thoughts just now is, given that the EU is being left out of things just now, maybe it could be that the US agrees to take back reduced Russian sanctions on energy and the EU doesn't. So that's one option. So the EU kind of wants to save face in this kind of context. I don't think EU's going to it's not going to take back Russian gas or Russian oil. I don't think that's on the horizon anytime soon.
Yep.
But we could have the US dropping some sanctions. So just things to think about. The US is starved of resid at the moment. We can tell that from various things, crude prices, resid stocks. And, there's just something to think about in terms of, could Russian high sulfur straight run start to flow to the US again? Does the US take a bit more euros? And just another thing on top of another thing on top of that. At least let's stick with a straight run. There's various things that could happen on top of that. So if you mix TI and HSSR, you come up with a kind of Basra medium type mix. Yeah. What impact does that have on TI Brent if we're sort of moving up internal TI use versus where we thought we were going to be last week? So that's my initial thought on that. Anything else that you guys can think of?
I would be sorry. I was just going to say my initial kind of read might be a little bit less jumping to all of those kind of endpoints. I think so long as they're still within the negotiations, or once the talks start, I think the typical kind of, I suppose, Trump or US or just general kind of negotiating strategy would be to keep the pressure on throughout the talks. So unless we're thinking that there's going to be some kind of deal happening within a month or so, I think I would be surprised if we see US sanctions lifted or even kind of loosened for quite a while yet.
That's what's been said this morning as well. There's a risk of, that's the statement, saying that we might even raise or increase the pressure to get a deal done. Okay. So I fully agree in the short term. I'm just thinking, what happens after a deal? What's the big risk?
I was going to say, I think my comment is around the timing bit, so that Phil just picked up. I get the argument on the straight run, and we'll delve into the fuel oil piece kind of shortly. But look, I think it's one to watch. It'll be an interesting one, and also really hard to call as well, if I'm honest. So I think this is a conversation that we're going to keep on having over the next couple of weeks. Okay, what else have we got?
Well, I think from as we were saying, kind of whether it's the US or EU deals and sanctions lifting, it does seem to have had an impact, or the tweet from last night seems to have had an impact already this morning on TTF. European gas. So we mentioned that it almost hit $60 per megawatt hour at the beginning of the week. It's now down at about 52, 53, and that is partly on potentially the stuff from yesterday, but it was already falling earlier this week, and inventories have continued to draw as they typically do at this time of year, and the draws have been relatively big. But the trajectory on kind of where we look as though we might end heating season looks a little bit less dire than it did a couple of weeks ago. And at current pricing, it seems that the marginal LNG barrels are pointing towards Europe. So in terms of looking at kind of resupply through Q2 and through for the summer. So I think my outlook is a little bit less bullish than it was maybe a few weeks ago, especially also for summer pricing. And, you know, we've now got all of the Russia-Ukraine kind of potential talk, which is likely to diminish that as well. Yeah. That being said, Europe is cold again.
I was going to say, and US, to be fair, looking at kind of a bit of a cold snap, right?
Exactly. So we're not out of the winter yet. And I think I've seen a couple of pieces talking about kind of oil to gas switching and whether that's going to be having an impact. Obviously, you know, in terms of very expensive fuel oil, but I think it's more of a story for Asia still. It's kind of a couple of markets in Asia rather than a European story. For the European story, it still remains that what we talked about kind of at the beginning of the year in terms of, you know, expensive nat gas makes refining more expensive, hydrocracker margins in particular, and, you know, compared to where we were in the beginning of Q4, for example, you know, we're 20% higher or 30% higher on TTF pricing, which maybe adds a couple of dollars a barrel on a hydrocracker margin. So that's not going away just yet. But I think overall, I'm slightly less bullish European nat gas than I was a few weeks ago.
Okay. I think we've got a bit about refinery margins kind of globally anyway, and we can chat through that in a little bit. So keen to push on because we've got a massive kind of list to get through today. Neil, fuel oil, showing notable strengths. We just touched upon kind of the US kind of shortage of resid. But look, high sulfur cracks are firm, spreads are holding up, though not as strong as what cracks suggest, I think was the comments that you've put in. There's also an interesting disconnect between the physical and the paper market. So look, what's driving this and how do you see this actually playing out?
Yeah, so maybe I do this relatively quickly because Hua is our expert and he's coming on next week. So we'll do a bit of an Asian special next week. Felipe is in Singapore, and so June and Hua are going to come on. So Hua's going to do a bit more on this. But just to note, basically positive high sulfur cracks. It doesn't happen very often. There is a bit of a disconnect at the front, so there's no real urgency in front spreads, let's say. And that's why we're quite convinced that there's a big, let's say, speculative or geopolitical element to all this, right? So obviously there's been sort of headline after headline, Russian high sulfur straight run may or may not be available in the market. Same with Iranian crude. Generally, there's a very tight sour crude market, particularly in the east, but also now in the west. There's all kinds of tariff threats going on, and all of it is basically aimed at the resid market ultimately, and most of it's high sulfur as well. So there's a big geopolitical element, and there probably is also expectations of things like more ton miles from all of this trade rerouting, right? So there's probably a bunker demand element, and we've just discussed nat gas. So the fuel oil switching, gas to fuel oil switching, that happens, as Phil said, in places like Bangladesh. That's a big deal for the relatively small fuel oil market. Gasoil switching, not so much, right? I mean, I know we get the headlines comparing gasoil to TTF prices, but I don't think it's a big deal just now in terms of switching for power gen and things like that.
Okay. So what have we got next then? Stronger margins, kind of refining? Suggesting higher runs?
Yeah, look at the simple margin. It's extremely strong, the simple margins. Obviously, we're heading into peak turnaround season, at least in Europe, probably in Asia. I think US is coming out of the peak now, looking at the data. So we will get higher runs in relatively short order. Simple margins are extremely good, so we'll get more supply. And we know there is demand destruction happening in China in particular, right? And that is less about, let's say, sanctions threats on Iranian crude and Russian crude. I think that they will find ways around that, but it's more about let's say, the tax changes in China, which are sending Shandong econs lower, right? And by the looks of it, from the data, the Shandong runs are dropping a lot. And there will be some effort to get more crude in, but remember, not all of these refiners have crude quotas, right? Import quotas. So it looks like there'll be demand destruction there. And just another data point, one of my favorite data points from the weekly data from the US is the gross refinery inputs versus the crude inputs. And those have been low for some time already, but they're super low now. So it just another data point to confirm that the resid market, also the resid that US imports and refines, is tight, and the US resid stocks are extremely low again. So there will be demand destruction, more supply. I think also the geopolitical element eases short term because there's a lot of fear around still, but most of it's fear. I think we've discussed many times on this pod. We think that will ease. So I think the high sulfur complex looks shaky. That's the ultimate element. But
all right. Really looking forward to having Hua on the pod next week with Felipe in Singapore then in that case. So we'll follow that on. So look, we'll do a bit of a switch. So Neil, you can take a breather. Phil, I'm going to head to you. So looking at light ends. So EBOB was exposed last week. TC2 has helped our exports recover a little bit though, I think. But look, with the TA-ARB widening, how is the winter to summer spec shift unfolding? And I think you released a snippet this week as well, talking about the early gasoline blending for summer and what's driving that. So keen to pick kind of thoughts on that one.
Yeah, so as you said, the main message from last week was that we thought EBOB had been kind of left out on a limb a little bit, and that has come in to a certain extent. So the east-west has moved back kind of towards in Singapore's favour. The TA-ARB was widened, so RBOB strengthening relative versus EBOB, and TC2, which we said was kind of also dislocated essentially, has come in a lot. So that has helped to rebalance, I suppose, especially the Atlantic Basin gasoline market. The interesting story that remains is that despite the east-west coming in a little bit, so it was at kind of minus 190 levels and now minus 120-ish, Singapore and AG actually exports still look pretty competitive into Africa, into West Africa, and also into Trans-Pacific. So the East of Suez still looks like it's pretty well supported, and part of that, maybe we talk about this in a bit more detail at some stage, but part of that is just that TC17, so LR rates in the East of Suez are still quite low. And what has happened there, or what that's meaning essentially, is that from our freight dashboard, everything is open. All the ARBs are open out of the AG, especially on LRs, and so this looks like a really good. Yeah, and it looks like a very good time essentially to get into that particular FFA, because there is a lot of demand coming. It doesn't look like the vessel list is particularly long either. So yeah, it's from a gasoline perspective, there's opportunities there, but also from naphtha and distillate as well. So the whole clean complex out of the AG looks pretty supportive.
Sounds like something that you need to write a snippet on, or we'll ask kind of our esteemed colleague Michael to write a snippet on in that case. So
keep an eye out. By the time you hear this podcast, hopefully there's something on the platform. Exactly.
But maybe just on that, I think just to round that out, I think our forecast on the TC17 FFA is the biggest spread between our forecast and the actual just now than I think we've seen in basically the whole time that we've launched the freight product, right? I mean, we need to check that. I'm probably just pulling things out of the air, but it looks big.
It's one of the most convincing bullish positions that we've had, right? On the freight side.
It's what, $7.50, $8 a ton, kind of a bullish signal. It's pretty significant. Usually we're talking kind of 2 or 3 max. So yeah, very much significant. Okay. Rich, you also asked about the winter versus summer spec, which I think is something which has been a big topic already in the Atlantic Basin in particular over the last few weeks. So typically, it's not uncommon to see summer spec already being blended in ARA or in New York throughout Q1. The fact that we saw that happening or as early as kind of early or mid-January is a little bit unusual. And what drove that was the fact that we had a very significant contango in both EBOB and RBOB, a relatively weak prompt gasoline market, obviously, as reflected by that contango. And as far as we can tell, in terms of available storage data, or just looking at the prices, looking at things like refmat premia, which we've mentioned before, it looks as though that has been something which has really been utilized, and is now leaving us in a situation where we have a bit of a dichotomy between the next few weeks, where we still need to produce winter spec and sell that into the window in ARA, for example. And when we get into Q2, when we move into April, and we're looking at kind of then using or drawing down all of this summer spec that's been blended already, that then puts a real cap on the summer on the Q2 market at least. Yeah. So we've got potential kind of, the prompt physical market still looks quite strong.
Yeah.
For the next few weeks. Blend margins are closed. I think we've got a situation whereby we can keep EBOB and RBOB relatively well supported. We're back in backwardation now in the prompt, but once we move into Q2, the upside is very much capped, because we need to then start actually eating through all of this stuff that we've kind of blended already.
So it's basically kind of blend now, kind of suffer the consequences going into Q2 unless demand kind of outperforms.
Yeah, exactly. Or you get a couple of refineries blowing up, and that that can always help as well.
Let's not joke about that one.
No, you're right. Sorry. I think in terms of kind of prompt opportunities, there are still a couple of outlets for ARA in particular. The heavy naphtha arb from ARA to New York, which has been open for months, remains open, and is open by more than it has been for a long time. So it looks as though there is still components moving out of ARA transatlantic, even if it's not finished RBOB. If it is finished RBOB, it's already summer spec. So it's F1 coming out of ARA and moving across.
Interesting. Okay, so where do we go from here then? Any news on inventories, or do you want to move into naphtha?
Just very, very quick one. We don't. Our probably remaining blind spot would be Pad 5 for a lot of the market, but it looks as though Pad 5 gasoline inventories in particular have been dropping, and we've seen ARBs that are very open now from Singapore and from Asia in general into Pad 5 into West Coast Mexico. So those ARBs should be moving to kind of resupply there, but it looks, going kind of across the barrel, that we've got pretty open gasoline, distillate, diesel and jet ARBs all open into Los Angeles at the moment. Okay. And why that is exactly?
I was going to say, that's surely short-term and turnaround driven, right? Or
so either it's, turnarounds in Pad 5. It seems like it's more of a US story than an Asian push, I would say. There isn't much telling us that there is kind of, there's no massive surplus. The physical premium in Asia are holding up. So this certainly seems like more of a Pad 5 pull than an Asian push. Yeah.
Okay. Any news on naphtha, just to round out kind of the top of the light ends part of the barrel?
Yeah, I always feel a little bit as though I need to not shortchange naphtha when Jorge's not on the podcast. So we talked last week about the ARB into the Far East being closed, and it was the physical premium that had done that. The physical premium in Asia have rebounded in response to that. So we said it was going to be unsustainable to have just all of the ARBs into the Far East being closed, and indeed the physical market has responded. And then just going back to the Atlantic Basin, it's not unusual, or it hasn't been unusual the last few months, to see the ARB from Europe into New York being open for heavy naphtha, but at the moment all of the ARBs into New York, so including from Houston, including from Dangote, for example, are open into New York for naphtha specs. So it looks as though there's a decent pull for blending specs, but also just naphtha in general. They look to be taking any kind of naphtha they can get their hands on in Pad 1 at the moment.
Okay, so Pad 1 blending is the story to watch for now then.
Indeed.
Okay, let's give you a bit of a break, Phil. Neil, I'm looking back at you. Let's have a bit of a chat around the crude part of the market. Look, you wrote in the commentary this week and highlighted some really key crude trends. So we're seeing some major shifts in some crude trade flows. We've a potential North Sea overhang. You can correct me on that if I'm not on point. And even some more indications of 40s heading east. So look, WTI seems to be the cheapest option for Asia. So with margins improving, we touched upon earlier in fuel oil. I'm keen to hear how you think this is going to play out.
Okay.
Yeah.
Where do we start with that? So I guess the main trade that's being talked about at the moment is still the EFS. It feels a bit like a broken record the last 2-3 weeks, but the reality is the EFS has been quite volatile, right? So it has been wobbling up and down, partly, I think, being dragged around by flat price. So essentially what we've been talking about is kind of buying dips, and I still think that is relevant. And last week on the pod, we were talking about the EFS, and I think I was noting down some prices. So for example, the April Brent Dubai swap, when we recommended that, let's say that was trading about minus 40 cents.
Yeah.
I noted down yesterday I probably would take profit. I mean, it was trading about minus 5 cents yesterday, and today it's jumped up another 15 cents. We're now trading about plus 15 cents.
Okay.
So that helps. I still think there's more to go. So I still think that's the trade. So you're right. There is a mini glut in the North Sea. If you look at DFLs, if you look at kind of 40s FOBs in particular, what's behind that? I think majority of that is just turnarounds.
Yeah.
I think there's also, elements of high supply. So a lot has been talked about Tengiz supply because they basically expanded it, and they're more than on time. They're ahead of time in terms of the expansion. So that's one thing. But it still looks like West of Suez crude is very cheap in Asia, particularly the light sweets. So 40 still looks good into Asia. Saharan looks good. You talked about TI. TI looks extremely cheap.
Where are we on, just on that though, kind of has freight kind of had a bit of an impact on that as well in terms of, I don't know, VL rates? They've come off quite a bit as well, right, to help?
Yeah, they did spike and they are coming off. That's true. I think that also heads into the EFS trade. It allows Brent to float up a bit against Dubai, all else equal. And then, so for me, West of Suez crude still looks rather cheap in Asia. Yep. China, we know, is taking a lot more Angolan. They're going to take less Saudi crude this month because of the OSP hikes.
Yeah. And
the other side is the thing that we're thinking to add to this, to add certainty here, is the fact that Asia could buy a surprising amount of spot crude this cycle. So the one thing is OSPs, right? So term crude margins have come under a lot of pressure because Aramco and the like really went for it in terms of the OSP hikes. They really, And the other thing is the margin element, right? So last month margins were poor, very poor, and this month margins look better on spot at least. And term crude margins are not that bad.
Yeah.
So the thinking is probably Asia bought less last month, and now they're more in the market to cover shorts, and it's going to be spot rather than term, and it's going to be West of Suez. So that's the kind of thinking.
So it's likely it's likely baseload crude rather than kind of buying incremental crude to kind of run up kind of higher margins. It's more delaying kind of their buying pattern, really.
Possibly, yeah.
Okay.
And on the other side of the EFS trade, I still think if you look at just, I mean, I know they've come off a lot, but the spot premium for Middle East, they're still like +3. It's still really inflated. And as we've talked about from multiple elements, also the fuel oil market, there's a lot of fear around still. And I think we haven't gotten over the barrier of realizing that it's a very short-term disruption to Russian and Iranian flows, and we're going to get around it, all else equal. In terms of sanctions,
okay, then. Yeah. So EFS is still
until the next spanner in the works.
Yeah. Well, yeah, it's an interesting market, that's for sure.
And there are just incremental signals, right? So I think I read this morning that there's new Shandong companies buying up terminals to take Iranian and things like that. So all these incremental headlines help the realization that this is not so much a problem, let's say.
Cool. All right. So EFS is still the trade here and carry on buying dips. Really keen to see kind of how that works out for you over the next week or two. Neil, so keep writing down your numbers for that one.
Okay.
But look, let's talk WTI Brent. So I think this morning we're at $3.80. Where do we go from here?
Yeah, currently April trading now minus 390 now. This one's lower conviction. I'm
Okay.
I have to admit, I don't really know where this is going to go, but at least we can discuss.
Yeah,
So
let's do pros and cons then.
we've just discussed that we think Brent will find a floor, or the North Sea market will find a floor, because we're reaching a low point in terms of buying for turnarounds in the West.
Yeah.
And it's looking good in the East. Okay, so that's something. And the other thing for TI specifically is TI looks now extremely cheap in Asia, right? It's landing substantially cheaper than Murban, but we think Murban will have to cool.
Yeah.
So, and then the other thing for TI is it still looks kind of expensive in Europe, a bit less so than it did.
Yeah.
So I said in the comms, I think TI Brent could move past $4, right, down to like minus 420 or something. Maybe that can still happen short term. So the purpose of that would be to get TI landing a bit cheaper in Europe. TI will come under pressure in Asia, pressure in terms of the land value, if Murban really starts to cool a lot. And what's changed to the last couple of months is the US commercial crude stocks are rising quite rapidly, right? Also in Cushing. So we got a big build in Cushing last week for the first time in quite a while. So I still see room for TI to have to kind of weaken globally in the very short term. That is, I think, where the logic stands.
Okay.
But it's a very short-term phenomenon, because we're probably at peak TI balance looseness now, if you see what I mean, because US runs are now recovering. So things should tighten up a bit beyond the very short term. So I think does that make sense to you guys? I think that's where I'm landing.
It does. I think for me, kind of, it's just more on the timing, right? So if we're thinking about physically moving barrels, I mean, your Asia leg is always going to be your longest. So that kind of Murban weakening would be my leading indicator in terms of kind of where TI goes, because if that starts to weaken, then your flow has to kind of end up potentially, it has to clear into kind of Europe, unless kind of, again, kind of, as you said, US potentially could be coming out of kind of peak maintenance season. So that's early-ish, if I'm honest. So that might kind of, that's my nervousness around kind of the trade. I think if we were kind of another month kind of on maintenance, then you'd end up having a bit more conviction about kind of the weakening here. But as you said, for me, kind of my leading indicator would be Murban, and then having to clear kind of TI into Europe, but watching the US runs off the back of that.
Yeah, I think a key part still is the fact that we're producing internally these little numbers, to tell us from on a scale of 1 to 10 how expensive is a crude in a specific region. And in Asia, TI is a 1 just now, as in very cheap,
very cheap.
And in Europe, we're still at like 7. Also in the Med, so Northwest Yuban Med. So that's the key element that we've not really observed in our tool over the last year. Not often anyway. So that's the thing.
Okay. All right. Well, maybe that's one to watch then going into next week as we see the markets develop. So AFS is still number 1, TI Brent. Yeah, let's keep an eye on that one. So look, is there anything else that's interesting that's come up in the past week? You had some outages on Johan Sverdrup?
Yeah, so I mean, it's related, right? So the interesting thing that happened in the West now is the fact that the medium, I was going to say sour market, but it's really just the medium crude market, is at odds with the light sweet market. Mm-hmm. So light sweets are very cheap, kind of weak. Heavier crude is looking quite tight. Johan Sverdrup was one thing; it's had multiple power outages, but it was rallying before then. Liza and Guyanan grades look quite expensive. Mars in the Gulf Coast has been rallying. And
is that bottom of the barrel led, do you think? So is that kind of your resid piece?
I think, it all flows into the same kind of move. And also there's worries about Canada and Mexico, of course, because you've got forward buying to think about in terms of tariffs. And another piece of news that came up the other day was the fact that there might have been some quality issues on Maya over the last few weeks. So Maya having a very high water content than normal, and that might have sent Gulf Coast refiners into the seaborne market, into the ex-Mexican market, seaborne. So looking for other LATAM crudes to fill that. And then it probably figures into our little TI chat as well, because looking at our tool, the margins on the Gulf Coast between imported medium crudes and imported light crudes has narrowed quite a lot, like really quite a lot. So it's just an interesting little factoid to throw into the mix there. But interesting for you as well, for the clean products market. The news there as well was that also as a result of lack of quality feed, Dos Bocas has not been running for some time. I don't know if that can be confirmed, but that was in the news article. So just something to think about in terms of the Mexican exports or import needs as well.
Yeah, that's
maybe one for next time.
Yeah, we'll look into it and think about it in a bit more detail. But that's certainly been one that obviously we've spoken about it a lot over the last 6 or 9 months, and it's kind of blowing hot and cold, right?
Yeah, there's no certainty with Dos Bocas at the moment. That's definitely true.
Yeah.
All right. Looks like a bit of a Mexican dig for us for next week, or possibly the week after, actually, because I think next week is our Asia focus. So, right. Okay, let's round this out then. Thanks, Neil. Turning to you again then, Phil. Let's finish off with the middle distillates. So notable shifts this week. So we've got Northwest Europe cash diffs are rising. The East-West spreads have made Rotterdam a little bit more competitive. And I think there's been a wave of bullish speculative headlines, which we've probably touched upon kind of throughout the whole podcast, to be honest. As you mentioned earlier, cold weather setting in across the US and Eastern Europe. So what's standing out to you the most in the distillate market, Phil?
Yeah, so it's been, as you said, Atlantic Basin distillate has been getting support from a number of angles, and that's been reflected in the Northwest European cash diffs. So cash diffs and prompt spread has been rising. So it looks as though the European market has been doing a little bit more to try and pull in a few extra incremental barrels, especially with the kind of the US or the transatlantic arb hovering around occasionally opening, but the US has its own relatively tight distillate dynamics as well. So looking to bring in maybe a few more of those swing AG or West Coast India barrels, and the East-West has moved out to allow that to happen now. So the East-West has pushed our kind of Rotterdam via the Cape arb as we look at it into essentially parity with the arb to Singapore. And when we see that historically, that tends to mean that there's kind of a bit of a tendency. There's a tendency if it's half 6 of one and half a dozen of the other, that it will head west. So that should see some more flows towards Europe. But obviously, if it's going around the Cape, that's going to take a while to impact. The other things that we've seen obviously are things, as we mentioned, relatively higher nat gas pricing, harming hydrocracker margins at the margin, so adding a little bit more of an upside there, and we've seen also the headlines around the Suez reopening maybe being a little bit less secure than we thought. So everything, a lot of things pointing to a justifiably slightly stronger European distillate market, but
James will be very happy that you're continuing his bullish thread. So to mirror James's calls, I think I would still be relatively cautious on carrying that beyond Q1. Just looking elsewhere, the interesting thing that I had noted is that PAD 3 waterborne premia haven't really moved. So we've been talking about relatively tight US gasoline market, and disty stocks are tight, it seems, in PAD 3, but maybe there's not too much kind of worry on the Houston side of on the Gulf Coast side of things that they're going to be running into kind of constraints there. The physical market hasn't particularly moved, and even though there have been moments where the transatlantic arb has opened and the Brazilian premia are looking healthier again. So it looks like there should be, the HOGO widened on paper, which we said should happen, but it hasn't necessarily helped that transatlantic arb to stay open from a physical perspective. Most of that wider HOGO on paper has been driven by higher RVO in the US. So
something to kind of, I suppose, when you're actually thinking about trading this thing, you need to bear in mind that RVO is something that either you need to have a good handle on where it's going to go, or if you don't, then at least needs to be hedged in there. So even though the arb picture to Europe looks better on paper, I think overall it's going to take a few weeks or to actually filter through into flows when we're talking about stuff from the east, and stuff from the west. If we're looking at flows from the US, it's not been open consistently to really give us conviction that there's going to be a decent amount of cargoes actually landing anytime, short term.
Okay, so short-term bullishness, kind of, to be fair, we're mid-Feb, so Q1 is going to be done kind of very, very shortly. So,
soon.
Neil, were you going to pitch in there, or?
I like to inject bearishness. No, sometimes we say that it doesn't take much of an opening from the Gulf Coast in order to fix a bunch of cargoes. So that's one counter argument, I suppose. And the other thing I just wanted to say was just from a ARA stocks perspective, a big part of the reporting last week was the fact that ARA gasoline stocks were very high, supposedly. And we've talked about the winter versus summer spec element there. But distillates are supposedly not particularly tight in ARA either, higher than a couple of months ago, let's say. So maybe the picture is slightly different on the whole Europe perspective from the balance, and it's an ex-ARA thing. Or, maybe we correct. Maybe the physical situation is just not that bad.
Very prompt.
And, or there is just a lot of headline-driven type stuff going on. I mean, that is definitely true. You can see it in other parts of the market in fuel oil as well.
Okay. Well, maybe you want to kind of pick James's thoughts on. We'll ask him to split out kind of ARA from the rest of Europe and see where we get to in terms of sentiment on that one. Well, look, goodness, it's been a really busy podcast. I think we've whipped through that. The more commodities we end up covering kind of with Sparta, we're going to end up talking for hours, that's for sure. So in that sense, in general form, I'm going to ask you guys kind of, and between you two actually, what are the three key things that you're looking at? Now, I'm going to go off and take my FFA trade, so that one's off the table. So cross commodity, I know, sorry. So cross commodity, kind of, what are the three things that you guys are looking at over the next week that Felipe can follow up on?
I'll go, I suppose. I still would be looking at the Brent Dubai swaps. I guess I can see potentially another, I don't know, 30 cents to come on top of that. I'm looking at April just now.
Okay.
I think that's the only thing I have particular conviction on at the moment, apart from the fact that in the physical market, things like 40s looks too cheap. So I'm looking for the, FOB prices to come up in the North Sea eventually, that type of thing.
Okay, cool. Phil, how are you doing?
I'd point back to Q2 Atlantic Basin gasoline. So I think we've had the relative prompt strength that we have now in terms of everyone looking at a kind of supportive barge market and a prompt backwardation has carried through into a slight uptick in the spreads through Q2, and I think that's probably a little bit overdone. So I wouldn't be surprised if we get a bit of a surprise when we move into summer spec and actually it turns out that there's a lot of material around. So I suppose cautiousness on forward gasoline markets for the Atlantic Basin at least.
Brilliant. Okay, I'll leave you off the third one. We covered TC17, so I think we're good. Well, look, thank you so much to the both of you. That's been extremely interesting, as always, and a pleasure to kind of host this. Next week, we have got a Asia view. So Felipe will be in Singapore visiting some of our wonderful customers there, but also we'll have June and Hua. And I think, Neil, you're joining as well, right? So for the pod next week. But look, thanks to our listeners. Cool. Thanks to our listeners for joining us this week, and we look forward to speaking with you next week.
Cheers. Thank you.
Wonderful.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.